Peace and love, good people. Peace and love. Let's get right into it. We have the glossary of options by Webull Learn. Okay, y'all already know what I'm going to tell Webull. I need to see the name of the person who wrote this. All right, but here's a glossary of options. So basically, I'm going to go through 8 terms that you need to know if you're looking to start options. All right, if you want to start trading options, before we do the deep dive and get into all the intricacies, you need to know these 8 basic terms, okay? All right, here we go. Number 1, option types. You have a call and you have a put. A call is the right, not the obligation. This is crucial. A lot of us skip past this part. You have the right, but not the obligation. All right, that's why it's called an option, because you get to choose if you want to buy the stock at a specific price or not. You're not obligated to do it, but when you buy an option, you have the right to buy the stock at a specific price if it in fact reaches that price. The call buyer owns the right, whereas the call seller has the obligation. All right, so when you buy a call, you buy the right. You get the option to buy it or not. If you sell an option, you're locked in to the terms of the option. So if you agree to sell 100 shares of Nvidia at $180 if it reaches $180 by this Friday, if it reaches $190 by Wednesday, you still have to pay. You still have to sell those shares on Friday. You don't get to choose, all right? So option types, you have a call, the right, not the obligation, to buy stock at a specific price. A put, when you buy a put, you have the right, not the obligation, to sell stock at a specific price. The put buyer owns the right, whereas the put seller has the obligation. All right, I honestly haven't heard anybody put it quite like that before Webull Learn. So I'm going to give y'all some kudos for breaking it down like that. All right, so the call buyer owns the right. The put buyer owns the right. Call sellers and put sellers have the obligation. All right, don't let that go over your head. Number 2, options contracts. The notional contract size. All right, the notional contract size represents the amount of the underlying asset controlled by one option contract. For example, one standard listed options contract controls 100 shares of stock. All right, slow down. If I wanted to have control over 100 shares of a company that was too big for my budget, perhaps I would consider buying an options contract, which would give me the right, not the obligation, to take profit on the contract, just like I would take profit on shares once they go up. All right, control. It's like renting. You don't own it, but you can control it. Number 3, the contract multiplier represents the number of underlying assets, shares, controlled by an options contract. For standard equity options, one contract controls 100 shares of the underlying. The contract multiplier in this case is 100. All right, so again, if you get, for every one contract, you're going to get control of 100 shares. So a lot of day traders, when they're who just trade stocks, professionals, they trade in lots. A lot is 1,000 shares. So if they say I'm about to do one lot, that's 1,000 shares. If I'm going to do 2 lots, that's 2,000 shares. So if you're trading options, how do you think you would arrive at one lot? I'll wait. I'm not gonna wait that long. You would need 10 contracts. So one lot in options is equivalent to 10 contracts. That's 1,000 shares. All right. 10 contracts is equivalent to you having the right to control 1,000 shares. All right. So that's the target. We want to get really, really good with our execution, and then we want to be able to scale our position to 1 lot, 2 lot, 10 lots. All right. Boom. The underlying asset. So a lot of times when we're reading, some of us learn better reading than watching videos and listening to audio. So when you're reading, the underlying asset sometimes can throw people off. So let's break it down. An underlying asset. 1, a stock, a security that represents partial ownership measured in shares of a company. Options contracts on single name stocks derive their value from the price of the underlying shares. So when you see underlying asset, or when they say the underlying, they're talking about either 1, a stock, or 2, an index. All right, so an index is an indicator or measurement tool that tracks the performance of a group of assets or a basket of securities. Options on an index are typically cash settled because the index itself is not directly tradable. So like SPX, the QQQ, at that point you're trading the index. All right, you're not trading a stock. All right. Number 4. We got 1, 2. We got 1, 2, 3, 4. All right. So the expiration, expiry, or expiration, the specified date and time when the options contract ends or expires. All right. So you got to know that there's a lot of intricacies tied to the expiration date that we need to truly wrap our minds around. But before we get into that, you need to understand exactly what the expiration date is. You know, the closer you get to expiration, it impacts the value of the option. So the expiration date isn't just like the finish line. It's a measurement, and it's very, very impactful. All right, on the value of your contract or contracts, especially if you're looking at doing 1 lot or 10 contracts. All right, now LEAPs, long-term equity anticipation securities. LEAPs options have the same characteristics as those of standard listed options, but with expiration dates up to 3 years in the future. So one of the biggest challenges with options is not always did you get the direction right. Sometimes it's not about whether or not you got the direction right. Sometimes it's about if you gave it enough time to move in the direction that you needed it to move, as much as you needed it to move. So when you do leaps, when you push an expiration date out 2-3 years into the future, you're giving it more than enough time to move. Now, there's other ways in which that might impact the value, whether your delta is going to be much smaller because you sent it way out in the future, or depending on how far you are away from the strike price. But we do need to consider that leaps is not that far from owning a stock for an extended period of time. If you know you're going to buy shares of something and you're not going to hold it for 5 and 10 years, and you want to do options and make some money, maybe you would want to consider leaps. All right, next up we have the moneyness. All right, so I just mentioned this, strike price, the price paid or received for the underlying asset if the options contract is exercised. So the strike price is the price paid or received for the stock or the index if the options contract is exercised. All right, so that's our target, our strike price. We believe that it's going to reach $18 by X date. Next, we have at the money. At the money describes an options contract that has a strike price equal to the market price of the underlying asset. All right, describes an options contract that has a strike price equal to the market price of the underlying asset. So if right now, you know, Palantir is trading at 150, and then you do an option with an expiration date a month out, but the strike price is 150. That means that you're buying an option at the money. It's literally at the money. Instead of we're gonna say money is price, so we'll say at the price. So at the money is at the price. So when you're looking at an option, what is the current price? If the current price is $73, you can buy an option at the money. So at the price. So you can buy an option at $73. That'll be the strike price. In the money is next. So calls. A call option is described as in the money, or ITM, if the market price of the stock is above the strike price. If the market price of the stock is above the strike price. So in the money. So if you look at $20, what prices are inside of 20? I would say everything under 20. 20 is like the opening of the box, and then everything inside of it. So when you're doing a call, if you're in the money, you're looking at any strike price under $20. If you get a $20 strike price, that's at the money. Anything under 20 is inside of it. It's in the money. All right. When you're looking at a puts contract, a put option is described as in the money, or ITM, if the market price of the underlying asset is below the strike price. All right. So again, with puts, it's inverted. So if the $20 strike price, if you're buying a put with a $20 strike price and the current price of the underlying is 20, then you still are buying a put in the at the money. Now, puts, you're betting that things go down. All right, we should know this already. You're betting that the price will drop. So anything above the price, if you're turning a box upside down, anything on top of the number is in the money. So with puts, you know, if you're betting that it's going to go down, if it's $20 and you're betting it's going to go down, if you pick a strike price of 21, 22, 23, 24, anything over 20, that is in the money for puts. Out of the money is reverse. Calls. A call option is described as out of the money, or OTM, if the market price of the stock is below the strike price. Puts. A put option is described as out of the money, or OTM, if the market price of the stock is above the strike price. So again, everything, this is the tricky part of options. This is the first hurdle. I call this the first hurdle. Understanding calls, puts, and moneyness. All right, I'm sure that was a bit confusing if this is the first time you heard it. If you were on the fence about it, that may or may not have helped you. All right, because sometimes you got to listen to things over and over and over again until it clicks. Okay. Premium / price. The amount paid or received for the options contract. So we got two values, intrinsic value and time value, with a premium. Intrinsic value represents the current value portion of an option, which is the difference between the current price of the stock and the strike price of the option. The intrinsic value is the amount an option is in the money. For example, stock XYZ is trading at $200. The $195 calls can be described as in the money and have $5 of intrinsic value. Time value represents the portion of the option's premium based on the amount of time remaining until its expiration date. Time value is often estimated at the difference between the option's premium and its intrinsic value. Okay. Time value represents the portion of the option's premium based on the amount of time remaining until its expiration date. Time value is often estimated as the difference between the option's premium and its intrinsic value. Okay. All right. Options, Greeks. So again, you know, you got to just keep in mind that the premium is what you pay when you're buying calls, inputs, and it's also what you receive. So like if you ever are watching the stock and you want to buy a call and you might be looking at the options chain and it shows that the option is $2.50. You might also notice that in real time, you're like, should I buy it? And then you're watching it go up 250, 255, 260, 280, 290. 300. You like, dang, I should have just jumped in. I just missed $40 because it was a 40-cent move on the option. All right, so sometimes, and then as you get, as the time expires on the option, as each day goes by, the value of the option becomes smaller and smaller because we're getting closer to that expiration date. All right, now we have options, Greeks. All right, Greeks. Measures that determine the sensitivity of the option's price to changes in certain variables like the price of the underlying asset, the rate of changes in the price of the underlying asset, time decay, implied volatility, and interest rates. Okay, delta. Delta measures the change in the option's price given a $1 change in the price of the underlying asset. All right, so for every dollar the stock moves, the delta represents how much the option will move. So if you have a 0.60 delta, for every dollar the stock moves, your option will increase 60 cents. Gamma measures the change in delta for a $1 change in the price of the underlying asset. So as your delta moves, it might increase. As the stock moves up, the delta might increase. So gamma is going to tell you how much the delta increases. So let's say you start off with a 60 delta and then it goes up $5. Well, now your delta might not be just 0.60, it might be 0.625. And gamma is going to tell you if it's going to move up 0.25 every dollar, or if it's going to move up 0.5 every dollar. So gamma is gonna tell you how much the delta is gonna increase. Theta measures the change in the options price as time to expiration decreases, also known as time decay. Since both puts and calls are susceptible to time decay, theta is always expressed as a negative number. So theta is the alligator. They call it the theta gator. Okay, it's gonna eat away at the value of your option with time. So as the price increases or the value of your option increases, the delta will increase. So you'll start to make more money for every dollar that the stock moves in your direction. The gamma is going to tell you how much more you're going to earn for each dollar move. The theta is going to eat away at the value over time. So theta is going to say, okay, well, today it's a 0.60. Tomorrow it might be a 0.58. The following day it might be a 0.56. And theta is going to tell you how much it's going to decrease each day. Vega. Vega measures the change in the option price for a 1% change in the implied volatility of the underlying asset. Recall that volatility is simply a measure of the amount of a stock price Recall that volatility is simply a measure of the amount a stock price fluctuates. It is worth mentioning that there are two types of volatility, historical and implied. Historical volatility is calculated using past or historical prices of the stock. Implied volatility is a forward-looking measure that is calculated using an options pricing model and the current option price as an input to imply the future volatility of the stock. All right, so The Vega is going to tell you how much fluctuation the option is going to experience for every 1% change. Now, Rho measures the change in the options price for a 1% change in the risk-free interest rate. All right, more on that later. Lastly, what is the OCC? The OCC, Options Clearing Corporation. Established in 1973, the OCC is the only company that clears and settles every listed options trade in the U.S. This means that it functions as the buyer to every seller and the seller to every buyer in the U.S. listed options market. Whoa. All right. So the OCC functions as the buyer to every seller and the seller to every buyer in the U.S. listed options market. It plays a key role by promoting stability and financial integrity in the marketplaces, overseeing options, exercise, and settlement processes, and managing the risks involved in the clearing and settlement process itself. By acting as a guarantor, the OCC ensures that the obligations of the contracts it clears are fulfilled. Right. So the Options Clearing Corporation. So, okay, they're like I guess they're the insurance. So if their buyers and sellers can't be matched, or they're responsible for matching all the buyers and sellers, and they may even have to cover any losses incurred or any issues made on their end. I'm noticing that sometimes in Robinhood, I could enter an option for sale before the market opens, and they'll match me with somebody that is buying it for way more than I'm selling it for, and I'm wondering who gets the short end of the stick when that happens, because it wasn't me. I got more than I bargained for. Thanks a lot. All right, so that's that. All right, we bull earn. I like that run through. We got option types, options contracts, underlying assets, expiration, moneyness, premium, options Greeks, and the OCC, the Options Clearing Corporation. Peace and love. I hope this helps. I hope you get rich, and I would love for you to comment, subscribe, and share this video. Peace and love, and I'll see you in the next one.